This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, MICHAEL COVEL. Not filtered, raw, honest. That's my passion. My guest today is Ben Hunt. This is Ben's second appearance on my show. He is the Chief Risk Officer of Salient Partners. He's also the author of Epsilon Theory, a really cool way of looking at capital markets through the lens of game theory. I always enjoy my conversations with Ben. His letter is excellent. I hope you enjoy this conversation. There's a great quote that I want to read of yours. But once you leave the cozy confines of the mutual coordination Nash equilibrium, you can never go back. Instead, it's an inexorable one-way street to the other Nash equilibrium, mutual defection. It's just math and human nature. And I wouldn't want to bet against that combination. I'm going to unpack that with you in a moment, but I want to add a few more thoughts from me right here at the beginning. What I really love about your work is you're not trying to tell me, you're not trying to tell the audience, hey, my name is Ben Hunt. I know exactly what's going to happen tomorrow in this market, this market, this market. No. But what you are doing is you're painting a picture using game theory that ties together an understanding of economics, politics, international relations, state power to get people to understand that if everything that you're saying is true, can there be any worse strategy, any worse investing strategy than buy and hold long-only U.S. stocks?
It's what I call the great muddy middle. And no, I in this environment, I think that's exactly the wrong place to be.
Yeah, I mean, I think that's what's cool about your work is you're getting people to understand, and there's some depth to your work for sure, but you're getting people to understand that if this is how we work in society, if this is how central banks operate, if this is how the political leaders operate, and we as the peasant sheep class, then it really makes a lot of sense to be looking at almost any other strategy except buy and hold.
Well, look, I think that's right, and we can approach that from a couple of different directions. You can approach it from the direction of negative rates taking hold around the world, such that the risk-free rate is now, if not zero and negative, certainly headed in that direction. So when compounding doesn't work, when your risk-free rate is negative, when time no longer works on your side, then absolutely buy and hold, which the whole notion of compounding over time, which is not only, I think, the most powerful investment force in human history, but is also the article of faith on which all or almost all investors operate. Not only does that go out the window, but more to your point about using equities to express that, it goes against every idea of what, not to try to predict what's going to happen, but to predict that when we've got a political environment of surprise and shock, which always comes out of polarization, that great muddy middle of, call it U.S. large cap stocks or any sort of buy and hold strategy for just plain equities. The only thing that I can predict with any accuracy is that you're going to be surprised. You're going to be negatively surprised at how poorly those holdings do.
Let me let you start with your view, your narrative of current central bank policies around the world. I want to read one more sentence from you, though, that I think sets this up nicely. Monetary policy is now firmly a creature of each nation's domestic politics, and the narrative of central bank omnipotence is devolving into a narrative of central bank competition. Now, that's a little academic sounding, perhaps, for many, but why don't you unpack that? Because I just love that sentence.
Oh, well, thanks, Mike. Look, what I mean by that is first of all, monetary policy has always been a creature of domestic politics, right? I mean, we can go back to any central bank head, whether we're talking about the U.S. or Europe or Japan, And we can see how it's, central bankers are politicians too. I don't think it's, that crazy to say that monetary policy is part and parcel of domestic politics, even if there's a veneer or my sense is kind of a pretense that they stand above domestic politics and that there's a science and a rationality to what they're doing that's separate apart from domestic politics. So I'll just, stipulate that first. But it's the nature of domestic politics which then is now being reflected in the nature of monetary policy. And what I mean by that is that when you have a world of massive debt, today we have far more debt sloshing around in the world than we did even in 2007 leading into the Great Recession, such that all the deleveraging, all the debt reduction that was supposed to take place as a result of the Great Recession did not. The holders of that debt shifted a bit, right? So the debt is no longer dominantly held by banks. It's no longer dominantly held by households, but it is now dominantly held by governments. So we have more debt than we did leading into the Great Recession. The ownership of that debt has shifted and it goes to governments. Exactly the same thing that happened in the 1930s. Yeah, the last time we had this much debt sloshing around in the world.
But nothing can go wrong when the government's in control of something like that. I mean, it's in government we trust.
Yeah, sure, right. And look, there's something to that. All right, there's something to that, and it does change the dynamics of I'll call it the debt negotiations. Governments can kick the can down the road a lot longer than households or private banks can. But it doesn't change the central nature of what's going on. And what's going on is that we are now in a world where the debt is so large that it's now really impossible for us to grow our way out of that debt. And so that leads that we have to inflate our way out of that debt or we have to assign losses. And no government in the world on its own free will is going to assign losses, right? They're going to impose austerity, right? That only happens if you're forced to do so, like Greece is being forced to do so by Germany and the IMF. Right? That's the only circumstances under which any government is going to impose austerity and losses. You try to inflate your way out of it. Now, what's the consequence of that? The consequence of inflation and massive debt is that income and wealth inequality grows enormously. Right? I'm not saying whether that's good or bad. I'm just saying that is. It just is. And the politics to deal with that becomes so much more fragmented. Whether that's reflected in political parties. I mean, look at the fragmentation in the U.S. Look at it in France. Look at it in the U.K. Look at it increasingly in Germany. Right? The political fragmentation within and between parties grows enormously. And as a result, centrist policies, the policies that dominate during what I'll call normal times, go by the wayside. The center does not hold. And this is what I mean that for markets, the only predictable thing is that we're going to be surprised by the politics of a debt-laden government owning the debt world. Again, it's exactly what happened in the 1930s and what happened in the 1870s, which was the prior period of time when the world was really awash in so much debt. And it's happening today. It's happening today, and that's what makes the standard rules of investing, stocks for the long haul, I want my portfolio to be dominated by, U.S. large cap quality companies. That's what makes these principles, which work during, I'll call them ordinary times, so much more difficult to implement effectively in the last 7 years when we really started living in this new world.
I mentioned my lead up. I talked about leaving the cozy confines of the mutual coordination Nash equilibrium. And
Yeah.
I know you're talking about amongst central banks. So why don't you explain how, up until, and I think the date you're putting on is late 2014, until late 2014, there's a certain coordination and that has devolved. And when that coordination devolves, something new happens. Explain that.
Yeah, it goes back to this notion that politics always trumps economics, and that the place to look first are the political necessities, particularly the domestic political necessities of the big four economies that drive the world. That's the U.S., that's Europe, that's Japan, and that's China. And what you see in central bank policy and monetary policy is really a reflection of the domestic politics and domestic political interactions within those four countries. So with the aftermath of the Great Recession, look, this was an existential threat to the political essence of all four of these countries. And in all four of these countries, or in the case of the European Union regions, reacted in similar, slightly different, particularly in the case of China, in their domestic political response to the Great Recession. But they all reacted similarly. It's the sort of existential threat that makes everyone come together, and it leads to, in game theory terms, a cooperative outcome, right? Where in many of these games you can have two what are called Nash equilibria, stable equilibria, and an equilibria just means a strategic interaction between countries. But when you have an existential threat, in the aftermath of something like the Great Recession, in early 2009, there was a coordinated effort by all central banks, because it was a coordinated effort by all of these governments to support financial assets, to buy stuff, right? and that was very successful. Look, the S&P 500 has tripled since the dark days, since the low point of March 6, 2009. In the immortal words of Ben Bernanke, it is, quote, probably not a coincidence. This is one of his Jackson Hole speeches. It is probably not a coincidence that the stock market rallied at the same time that central banks around the world began to buy stuff. There was this period of coordination, and it was reflected in the massive inflation in financial asset prices. Remember, this is what we're trying to do. We're trying to inflate stuff to get out of the debt problem. But what always happens in these circumstances, and again, we can go back to the 1930s as a kind of the last historical period when this sort of dynamic took place. We can also, as I say, go back to the 1870s for other examples. But what always happens in this environment is that the cooperation, it doesn't last, right? It's what I call this transition between the golden age of central bankers to the silver age of central bankers. And why does that happen? It happens because once you get past that emergency period, then each of these countries, or again in the case of Europe, regions, is going to think, all right, we're out of the emergency period. Now I've got to go back to doing the best I can for my economy, my people, my domestic politics. How can I grow? How can I grow the European economy, right? How can I grow the U.S. economy, Japan, China, right? How can I go back to growth? And the swing factor in growth, and this has been true for, well, probably about 2,000 years now, is trade, right? Exporting to other countries, that is the engine, that is the swing factor in GDP, if we want to get academic about it. It is the engine of economic growth. Every country in the world, once you're past that emergency stage of, oh my God, the world's going to end, okay, we stopped the world from ending, what now? Every country in the world wants to grow, and the best way to grow is to export more. How do you export more? You reduce your currency. In the playbook of international economics, this is play 1, 2, and 3. devalue your currency so that it's cheaper for other people, other countries to buy your stuff. It doesn't impact your domestic economy and the prices paid, right? It just spurs your exports and hence spurs your industrial production. It means you need more factories with more people making more real stuff to sell to other real people. We saw this happen, what I'll call not the currency wars, but the currency competition around trade started in summer of 2014. Why? Because it's the summer of 2014 when Janet Yellen comes out and says, all right, you know what, guys? We've been coordinating, we've been cooperating on everything we've been doing with monetary policy, but now the United States is going to go on its own course. The U.S. now has a tightening bias, meaning that we are going to look for an opportunity to raise interest rates. We've already tapered off our asset purchases. We're not buying stuff anymore. Now we're going to look to go even further and start to raise rates. And the rest of the world said, us, not so much. In fact, we're going to double down on lowering rates. We're not going to let the zero bound, a zero interest rate stop us. We're going to actually have negative interest rates. And we're not going to stop buying stuff either. In fact, we're going to double down on that. We're going to buy more stuff. So it's in the summer of 2014 when Yellen says we're going one direction. It's in the early fall of 2014 when Draghi in particular says we're going in a 180-degree different direction. So that's when the wheels start to fall off the wagon, when the rail car jumps the tracks, whatever analogy you want to use, is in that third quarter of 2014, because that's when the competition begins. And once the competition begins, and this is the nature of game theory, you can't go back to the happy days of cooperation until you have another emergency crisis that forces everyone to come back together. So that's when things went off the rails.
You've mentioned also, too, that when these types of periods happen, when the new terrible weapon, let's talk about, hey, we need to drop our currency and increase exports, all the players must adopt or they're out. In many ways, if you look at the traction of Trump and Sanders, right or wrong, I'm not making a value judgment, but they are clearly playing right into the same thought process as, for example, the Chinese. The Chinese say, hey, we're going to try to increase exports by dropping our currency. So everyone has to use this new tactic. And there's a lot of people that are using tactics, and it's a constant competition to keep up with the Joneses in terms of your tactics and strategy.
Yeah, look, I mean, you see this in warfare in particular, right? This is where the best examples are. So Germany in World War I starts using gas weapons, right? So immediately, in order to play the game, in order to be competitive in the game of war, the Allies adopted the same. You know, the U.S. develops nuclear weapons, uses them in 1945, right? That immediately sparks the Soviet Union to do the same. You have to take action not just in the same degree as your opponents, and you have to think of this as opponents. I don't mean opponents in the sense of we're fighting like warfare, but I mean in the sense of a competitive, strategic interaction, like playing a game of poker. Right? If you're sitting at a table with poker players and they're all playing a particular style, right, it's probably not going to do well for you if you don't at least incorporate aspects of that style into your own game. You have to do it now. You have to react not just in scope, but in the actual instruments that are being used. Unless you want to just roll over and play for dead. And you mentioned Trump and Sanders. My best example of this are the debating tactics that Trump used in the Republican primary to date.
Forced everyone else to use the same thing.
It forced everyone else to use the same thing, right? And now, it may not work as well for you as it does for him, right? I mean, as Marco Rubio about that. But unless you fight fire with fire, and that's what that old expression is all about, you're not going to succeed. You either need to avoid the competition entirely, not have a debate, right? which is now what Clinton is saying about Sanders, right? Well, I'm just going to not have a debate. Why would I engage in this at all, right? Or you have to fight fire with fire. And then that's what's going on internationally as well. So one country adopts negative interest rates, which is an extremely effective way of devaluing your currency, right? Because what really drives the value of a currency in international markets? Well, over the long haul, it's things like purchasing power, parity, and all this other stuff. But in the short term, it's, well, if I own a security that's denominated in currency X, and it's paying me 1% a year, versus a security denominated in currency Y, which is paying me nothing, I want the security of country X. It's going to pay me the 1%. The currency flows will move towards those countries which offer a higher rate of interest for these very short-term securities. And even if the U.S. is offering 0 or 0.1%, well, that's better than charging you, 0.5%, which is where Switzerland and Sweden and a lot of other countries are today. So these exchange rates are largely driven by interest rates, short-term interest rates. So that's why going to a negative and a more negative, a lower interest rate is such an effective weapon, tool to use to try to devalue your currency.
And I love what you say is that there is one great positive sum game in all of human economic history, trade. But right now, we're clearly getting into more of a zero-sum type situation. And again, I should stress, it's not that you and I are sitting here, and you especially, you're trying to say, I know what's going to happen. You don't have a crystal ball, but you're clearly pointing out that if we're moving from positive sum on trade to zero sum, the polarization that follows is somewhat predictable, as you said at the top of this call.
Yeah, it is predictable. So in 1930, the U.S. passed the Smoot-Hawley Tariff Act, right, which was the currency, the competitive game playing action of the day, right? It wasn't trying to devalue your currency; it was putting up tariff and quota barriers. But it has the same effect, right? And it has the same engine, the same rationale behind it. Now, for about a year after the U.S. passed the Smoot-Hawley Act, first other countries responded. Pretty much every country responded with their system of tariffs and quotas. But actually, even with the U.S. economy, it did okay in 1930, right? The U.S. was still, trade was a part of what we did, but wasn't a huge part of the economy. Similarly to today, where trade is a swing factor in our GDP growth rate, but we are still primarily a domestic consumption-driven economy. But in 1931, one of the biggest banks in Europe failed, called Credit Anstalt. It was actually part of Deutsche Bank today, which is kind of poetic irony at least. But Credit Anstalt went under, and the failure of that bank is what really triggered the financial repercussions, which really drove the Great Recession. Now, why did Credit Anstalt fail? It failed because the volumes of global trade declined once the U.S. imposed its trade barriers and other countries responded. It becomes a race to the bottom. A zero-sum game becomes a game where you're trying to hold on to your slice of a shrinking pie. And when the pie starts to shrink, that shrinkage accelerates as each country imposes these policies. In the case of the 1930s, tariffs and quotas. In the case of today, currency competitions really exercised through lower and lower interest rates. And the impact, though, in both cases on the banking system is the same. If I'm lending money, if I'm a merchant bank, right, if I'm lending money to traders and I will finance your inventory here, finance the building of this ship that, you're going to take goods from here to there. Well, when trade rolls over, when that pie starts to shrink, it's the banks that get killed. Right? It's the banks that get killed. And whenever you have that sort of financial crisis, that is a systemic crisis. It's again, it's just as you said, it's not trying to predict, which bank or how this all comes to pass, but, we've seen this movie before. It is just math. It is just human nature. We should recognize that.
I want to take you into models for a moment, and I want to start with a side tangent, which I know you're very good at. I love your movie quotes that you pull in, all of your colorful, cultural. We'd have to talk. I'd have to find out what your process is for finding all of these. But in the last bunch of years, there's been a guy out there. He's gotten so much press, so much notoriety. He was the political maestro. He could predict anything in politics. He has all the models, and all I've seen in the last 6 months is Nate Silver explaining why his models didn't work to predict anything with Trump. And it's right at the time that you're talking about that this shift, this divergence is happening. The easy breezy models that everybody believed that Nate Silver could predict tomorrow of any election, all of a sudden has just gone poof.
Yeah, look, it's the same reason that the models that the Fed uses to try to predict the impact of their monetary policy, it's the same reason those models aren't working either. And it all goes back to what I was describing earlier about how politics always trumps economics. And then when you have massive debt, and when the government now owns such a large portion of the debt, the politics of all of these major countries and regions changes dramatically. The polarization, both between political parties, within political parties, goes nuts. Not to get too technical and all about this, but it means that we move from what's called a single peaked distribution, something that looks like a bell curve of how people think or vote about a certain policy, to again, to use these words, a bimodal distribution, meaning a not a single peaked normal curve distribution of preferences and votes and the like, but a double peaked, a flat distribution of preferences that skew greatly towards the tails, towards the ends, as opposed to being in the middle. And, those are graphical representations I think everyone can kind of picture in their head of what it means to talk about fragmentation and polarization. But the result is that all of our models, whether we're talking about political prediction models or economic prediction models, all of them are based on what's called the central tendency, are based on a normal distribution, a bell curve of results. It's very similar to what, Nassim Taleb has written about, the, fooled by randomness and the, black swan events, talking about the tails, the fat tails of these, distributions. I'm talking about something a little bit different. We're not in a world of bell curves and normal distributions anymore. It's a very different shape to what people believe and act on, whether we're talking about voting or economic decisions. And so the models don't work because they're all built for a world that doesn't exist anymore. This is what I mean by, I would say, the only thing that I can predict is that the models and investing based on models, the investing based on these old ideas that worked pretty darn well for the last 50 years, you're going to get some unpleasant surprises. That's the only thing I can predict with confidence, that you're going to get both political shocks and economic shocks on both ends of whatever spectrum you're talking about, but they're going to surprise you. And that's why business as usual with our investment approach, I think, doesn't make sense in this environment.
You are in the investment arena. I have some involvement in that arena myself. I would like to bring up a particular individual that you've you've written about in your writings. Ray Dalio, I think he's managing more money than God right now. I don't say that in a negative way. I'm not here to try and to paint some kind of awful negative picture or anything like that. But I think it's open for discussion to wonder, not necessarily about Ray Dalio and his investment choices, but to wonder about the individuals and who those individuals represent and what's driving the masses to say we must give all of our money to essentially one guy who runs an automated model. It's fascinating that so many people, never before in the history of money management, I believe his assets under management are massive. But that's all the institutional players around the world, various high net worth people have just basically said, we all want to be together. We all want to be standing exactly together. And essentially this one man will just trust that he has the model.
What is most attractive about what Dalio and Bridgewater have created, and what has had the most success in terms of adoption is probably not just assets under management, right? It's an enormous amount of money that Bridgewater manages, but there are other sovereign wealth funds, there are other pools of capital certainly that are even larger than what Dalio and Bridgewater are managing. But where I think that what Bridgewater has created has had the most impact is really to answer your question about how money is aggregating, right? It's aggregating under a notion of process, right? Now often this process and maybe most easily a process can be implemented in a quantitative or systematic fashion, right? I mean that the nature of a quantitative approach forces one to write down and instantiate what is the process for investing. But I think even beyond just a quantitative or overtly systematic approach, the whole notion of having a rigorous process is one that really comes out of the Bridgewater approach. It's that idea that this is how one should manage money. Even if you're not managing money directly with Bridgewater, you're not managing money directly with a quantitative or systematic strategy, the notion that how one should manage money is through this sort of rigorous, iterative process. That, I think, is the most widely spread, influence of Dalio and Bridgewater.
And it can vary. I mean, let's face it, these quantitative approaches to the average investor, even perhaps a high net worth investor, institutional investor, I mean, these quantitative approaches across the spectrum can vary quite dramatically and be entirely different and unrelated to each other. Oh, for sure.
No, let a thousand flowers bloom. It's like I say, it's really not that there's one notion of what it means to have a systematic or quantitative approach to investing, but it's more the idea that one should have a very well-defined, rigorous, again, I'll use this word, iterative process for managing money. So it's not by gut feel, it's not by some sort of idiosyncratic take, it's not a seat-of-the-pants approach, but it's one that is, again, definable, and that often leads to an overtly definable process, which tends to come through numbers.
You quote from The Godfather, Hyman Roth, "This is the business that we have chosen." So for those that might be sitting out there and thinking that you and I are having this terribly bearish conversation that possibly the world is going to end, not what we're saying. We're kind of trying to unpack all this. It's quite complicated, obviously. But as Hyman Roth said, this is the business that we have chosen. So it's not only about sitting back and saying, hey, things are a little rough around the edges, but it's trying to figure out how to have a particular strategy when you know things are rough around the edges.
Yeah, and then this is I think is the most important thing for us to talk about, because Yeah, we can talk about the world, and I really do think that it's a very difficult world to invest in because of what's happening in the politics. And I can look at history and say, this is not an easy time to be an investor. But then that's compounded by the fact that for most investors, they're saying, well, but my toolkit is not, developing some, systematic strategy a la some big, enormous professional money manager. That's not who I am, right? And as investors, the worst thing you can try to do is to try to be someone who you're not, right? If you're much better off sticking with with what you've got, or just not playing the game at all. And that's what I when I talk to so many financial advisors and investors, are saying, look, my background, my toolkit, it's not working in this environment. I can't fight fire with fire. So what do I do? Do I just sit out? And look, for some people, they have that luxury, right? They can say, look, this isn't a world I understand. It's not a world I do well in, so I'm just going to sit out.
The toolkit you're talking about that most of them say that doesn't work for them right now is being fully invested throughout a market cycle, right?
Fully invested, right, but more than fully invested, it's how they're making those investment decisions. They're trying to make the investment decision based on company fundamentals, particularly on a factor of quality, right? I'm looking for a good management team. I'm looking for a fortress balance sheet. I'm looking for, GAAP earnings that I can understand and I think are sustainable. And, those are things that it's not that they're wrong to look at those things. They just don't matter very much in this environment. They don't matter very much in terms of the international political situation we're in, and they don't matter much in terms of who else is sitting down at the table with you and playing the game of markets. Sticking to this notion we have to be invested in stocks for the long haul and this kind of, again, what I call the great muddy middle of just owning lots of, U.S. large cap stocks, but moreover, making your stock picking decisions or sector picking decisions on the basis of some notion of quality or the sort of fundamental analysis. So a lot of people are say family off saying, all right, well look, I'm just going to take my ball and go home for a while. I'm going to go to cash. Look, there's nothing wrong with that, right? I think that when you're in a storm, one of the things you should do is watch your sales. Take down some sales. Reduce your gross exposure to these markets that, for whatever reason, aren't working for you. But for a lot of the others involved in the business, including our firm and lots of others, we don't have that luxury. It is what Hyman Roth said. This is the business we've chosen. We can't just take our ball and go home. We can't just go to cash. We have to compete. This is what I mean. This is where we have to compete. We have to find a strategy to do something, right, to help people who don't have the luxury of just waiting.
And you point out, quoting Keynes, and I love this quote, and people really need to think about this when they're dealing with their advisor or whatnot, it's often better for your reputation to fail conventionally than to succeed unconventionally. Meaning, I don't know if people necessarily understand that their particular trusted advisor is really not incentivized to think the types of directions that you're going today. It doesn't really, there's no reputational incentive, is there?
No, and again, Keynes was writing in the 1930s, where exactly the same rhyme of history was happening then, where financial advisors then were saying, well, just buy stocks. It's the same thing. And if it fails, if everyone fails together, then it's as if no one really failed, right? It's the risk that, and it's not just for financial advisors, it's for anyone in any walk of life, right? The old saying in IT was, well, no one ever got fired for buying IBM. Right. And it's the same thing in investing today. No financial advisor ever got fired for buying an S&P 500 index fund for a client. And again, I talk to so many financial advisors. Hey, they're not stupid at all, right? They know what's going on, and they want to do better. They think, look, what we've been doing isn't working so well. I want to try something different. But all too often, so again, the old saying, it's the tallest blade, the blade of grass that sticks its head up is the blade of grass that gets cut first. And it's very hard to take a risk. And that's true for any walk of life, but it's certainly true for the financial advisory business.
Ben, let me take you through real quick, because I think this is really important. It kind of sums up some of this particular work that you're involved in right now. 5 easy pieces for the world as it is. Let me run through those with you really quick, and you can run. We're in a storm. Mind your sails. Yep.
Talked about that. So that's the whole notion of, look, watch your gross exposure, and it makes a ton of sense, I think, in this sort of environment to reduce your gross exposure to markets.
We're in a game. Play the player.
And this goes back to this notion of the markets, the game. The poker players you're sitting down with are the Dalios and the AQRs and the Bridgewaters of the world. And they're, for the most part, probably playing a different game than you are.
We're in a negative carry world. Think like a short seller.
Yeah, this is the notion that time no longer works on your side. And that's what negative carry is that you are paying to wait. Right? You're not getting paid to wait. Right? You're paying to wait. And when you're in that sort of environment, you have to look towards catalysts. And that's why I say think like a short seller. Because short sellers live in a negative carry world where time never works for them, it only works against them. So an effective short seller is always looking at catalysts as the real drivers for what investment choices he or she makes.
We're in a policy-driven market. Don't trust the models. We just touched on that already, and I'm not sure if you have anything else to add.
No. We talked about that, I think, at length, which is that all of our models, and these can be overt mathematical models like Nate Silver uses for politics, or the Fed uses for economics, or a lot of economists use for investment portfolios. All of these models are based on the idea, again, of what I'll call that central tendency, that you have in effect, something that looks like a single-peaked normal distribution of preferences and results. And in these sorts of times, that assumption is flawed. And so, the only predictable thing is that you're going to be negatively surprised, if you act according to these models, systematic or not.
Last but not least, a policy-controlled market is next. Look to real assets. Talk about this "is next" part. I'm not sure I followed that exactly.
Well. So look. Here's where the puck is moving. The puck is moving towards central banks to become even more directly involved in markets. What do I mean by that? I mean that we started in 2009 with central banks buying government debt. Right? That's where the Fed, when the Fed launched QE, what does that mean? It means that they are buying assets. What are they buying? They're buying U.S. treasuries. They're buying U.S. government debt. When the European version of QE started, they're doing the same thing. We're going to buy sovereign debt. Now, Japan's been doing this longer than anyone, and they started to expand what they would buy. All right, it's not just going to be sovereign debt, our own sovereign debt. It's also going to be government bonds. Corporate bonds. It's also going to be ETFs. And one country's doing it, okay, well, that's something. But it's just a point. It's just an idiosyncratic point. It's when 2 major countries start adopting this, or 3 major economic players start adopting it, that you see a pattern and a line and a shape take place. So now as the U.S. is now buying mortgage-backed securities, now it's just announced that Europe is going to start buying corporate debt. Right? I can't tell you how important in a for me profoundly depressing way that this is. Right? Because now what we have is a central bank. Again, I'll use the poker analogy. It's a player with an infinite stack of chips is now saying, I'm going to sit down at the table with you, and I'm going to be here to pay $1.20 for corporate debt that's worth 70 cents. So, whatever fundamental analysis I'm doing about now corporate debt, we used to be sovereign bonds. Whatever sort of fundamental analysis I was doing about sovereign bonds means nothing when the central banks are sitting at the table and saying your fundamental analysis doesn't matter to me. Now these central banks are sitting down and are saying, well, now we're going to sit down at the table and we're going to play at the game where we're talking about corporate debt. And from there's an inexorable slide here where it goes from government debt to agency debt, mortgage-backed securities, to corporate debt, to financial debt, to equities. This is what I mean by a policy-controlled market, not controlled in the sense of ordering you to buy this or forbidding you to short that, but to sit down at the table directly and be a market player and have a goal not of rewarding quality companies, essentially punishing low-quality companies, but simply being there to turn all markets into a utility.
What did Bush say years ago? He was suspending the free market system to save the free market system. I guess the suspension never ended, huh?
Yeah, no, that's exactly right. That's exactly right. So Georges Clemenceau, he was the prime minister of France before and after World War I, and his famous quote was, "War is too important to be left to the generals." And I think the quote of any central banker or any status quo politician would be today, markets are too important to be left to investors. And that's why I think one needs to look at private markets. One needs to look at real assets, tangible things. Not that
their success for the last since March of '09, their success has been a straight up line. I mean, if they're going to get even more involved, it seems like a pretty good bet to just sit back and trust the system.
Well, let's see. I agree in the sense that we need the liquidity of public markets, and all of us who are involved in this, all of us who, don't have the luxury of taking our ball and going home, we have to stay involved in public markets. But what are our expectations for those public markets? What strategies should we be using to understand those public markets? And what I'm saying is that my expectations of public markets are simply that they are going to continue to be policy driven. They're going to be more policy controlled, which means that the rate of return that I'm going to expect from these markets is very muted. And the strategies I'm going to use to try to understand them have nothing to do with fundamentals, because that's not how governments are understanding and dominating these markets.
If you're right, it's just frightening.
Yeah, well, for me, it's depressing.
Yeah.
It's less frightening as it is depressing. But look, the hope for me is that, well, where can my analysis and my efforts still make a difference? And I think you find that in private markets, right, where I'm not going to sit down directly at the table with a central bank or with Ray Dalio, right? And I think you can also find a difference in real assets, which I would prefer to find in private markets, but sometimes I may find public markets are the best way to access those real assets.
One last thought. I don't really think, though, that your only concern about a policy-controlled market is simply low returns. I think in the back of your mind, as I go through your work, I think you read between the lines and sometimes just very directly, you're saying, hey, you do have to be aware that even if this policy-controlled market looks really nice, looks really swell, it's going the right direction, you very well likely are building up forces behind the scenes that when a crack happens or a bear happens, it could unfold in a dramatically different way than perhaps prior years. I mean, it's kind of brave new territory, isn't it?
Yeah, look, and it goes back to what I was saying about the overwhelming debt that sloshes around in the world. And there are only three ways to get out of that. You can grow your way out, you can inflate your way out, or you can assign losses and try to reset. There is no way, and I can give a lot of examples of why I say this, for us currently to grow our way out of this debt. We've tried and are trying to inflate our way out of this debt, to buy ourselves some time. But ultimately, what always happens is a political reset, which results in the assignment of losses. That can happen peacefully, or it can happen not so peacefully. But that will happen. We will have a reset, and that's going to be a very traumatic day. Let me put it at that. I'm not predicting, right? I'm just observing history, and ultimately this is what has to happen. There has to be a reset, and it always comes from politics.
Yeah, you quote Soros as saying, and people have their different views about Soros, but that is politically different views. But as a market player, he knows his stuff. I'm not expecting it. I'm observing it.
I'm observing it, right. Right, yeah. I think that's a great quote.
Yeah.
And I think that's what we have to be. We have to be observers, and we have to be not just of what's happening today, but of what's happened in the past. And that as opposed to having the hubris of trying to predict what's going to happen, I think the best one can achieve here is to react quickly to what's coming down the pike.
Ben, where can we send people? People need to go and read. How many PDFs, how many articles are you doing a month right now? I mean, I think it's even more interesting when you could sit down and read it all the way through, and you get all these kind of colorful quotes that you put in there. Where can we send people? And how many are you doing a month?
Well, look, I used to wake up at 3 a.m. with a knot in my stomach because I had to check the European returns for the portfolio I was managing. Today, I wake up at 3 a.m. with an idea that I want to write down for Epsilon Theory. So it's something I love doing, and it seems to have struck a chord with a lot of folks. So I'm just very grateful for that opportunity. But it is Epsilon Theory. That's where people should go look. Just do a quick search on Epsilon Theory.
Comes right up.
Yeah, you'll see a lot of stuff there.
Ben, I appreciate it as always. Thank you, sir.
My pleasure. Take care.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.